Hey guys, in this video, we're going to talk about one of the favorite loans that we do here. We get lots of questions, so especially from real estate investors, known as the DSCR loan. DSCR stands for Debt Service Coverage Ratio. In a minute, I'm going to show you exactly what that calculation looks like. I also call it the simple loan. It's really simple because we do not get any income on the loan application except for the income on the subject property. We don't use W-2 income. You don't even put it on the application. You leave that section blank. We do not use 2 years of tax returns for self-employed borrowers. We don't use bank statements for income like we do in some of our other loans. We don't get any income on your other rental properties. The only income that we look at here is the income on the subject property. If you're purchasing a property, the appraiser is going to tell us what the market rent is. If you're going to do a long-term rental, we'll use that. You can also use this loan, however, for short-term rental. So if it's a short-term rental property and that's your desire there, we'll tell the appraiser that and we'll use that analysis for income as well. It's a very simple loan, specifically targeted toward the income on the property. Understand that we're going to do a debt service calculation of this. I'm going to show you what that means in just a second here. We basically want the income on the property to service the debt on the property, and that's principal, interest, taxes, and insurance. We'll look at that in just 1 second here. Understand it's obviously for non-owner properties only. This is not a second home. This is not a primary residence loan. It is only for income producing properties. We typically go 1 to 4 units with this, but we can do more units than that, up to potentially 20 units. So if you have a 7 unit or an 8 unit, the guidelines are slightly different on that, but we can still do a simple debt service calculation, just like our 1 to 4 unit as well, and use just the income on the property to qualify for the loan. The maximum loan to value in this is 85%, which means the minimum down payment is 15%. What's interesting about this specific loan is the interest rate is calculated with a couple of different variables here. One of them is your credit score. The better the credit score, the lower the interest rate. The other one is the loan to value. That means the loan divided by the value of the property. Another way of saying that is the down payment. It needs to be a certain percentage, the minimum being 15%. The rate is lower with more down payment. So a 15% down payment loan for the exact same borrower and the exact same property will have a higher interest rate than if they put 20% down or 25% down or 30% down. So what we'll do is we'll show you those different options. Just to understand that you do need to have a minimum 15% down payment, and depending on our investor we place that with, some of those funds can potentially be gift funds. Typically a minimum of 10% of the 10% down payment needs to come from the borrower, and the rest of it can come from gift funds. Now let's take a look at what the debt service calculation looks like on this loan. The actual calculation for the income on this property and whether it works or not, guys, is really pretty simple. Debt service coverage ratio. So we take the rental income, and let's assume in this particular property that we're looking at, the rental income comes in at $3,500 a month. We use 100% of the market rental income. Now on short-term rentals, depending on the investor we place this loan with, that calculation can differ, but I do have 1 or 2 that will still use 100% of the short-term rental income. Some of them, because it's short-term rent, are going to discount that income by the 25% vacancy expense factor that you're used to on our typical loans. Normally on a Fannie Mae, Freddie Mac kind of loan, we're going to use 75% of the market rent to calculate what the income analysis is there for that. So there's a 25% what we call vacancy and expense factor. With the DSCR loan, typically, especially between 1 and 4 units, there is no 25% vacancy factor. We'll use 100% of the income. And then we take a look at the total mortgage payment. In this case, principal, interest, taxes, and insurance equals $3,300 a month. Now, for the total mortgage payment, if there's HOA dues or anything like that in there, we're going to include that in there. We can, however, use an interest-only payment for the mortgage payment, so it's not always principal interest. It might be just the interest-only payment plus taxes, plus insurance, and HOA dues there. Whatever that calculation is, whatever kind of loan we use, whatever the monthly payment comes up to, interest only or amortized, we're going to use that payment. And then the calculation is very simple. We're going to divide the income by the monthly payment. In this particular case, the income is $3,500 divided by $3,300 equals a debt service coverage ratio of 1.06%. And that's what we're looking for there. We typically want the debt service coverage ratio calculation, the one we just did here, to be 1% or higher. Or higher. We can do them with lower than that. So if the income is less than the mortgage payment, and we do this calculation, and hence the number comes out less than 1, like 0.85 or somewhere in there, we can still potentially do the loan. The parameters are going to change. We may ask for a larger down payment, so the loan to value may decrease, and the interest rate will likely go up because it's a more risky loan from the investor's perspective. But as you can see, it's a very simple calculation that we do here. You can do that on your own once you know what the mortgage payment's going to be, you know what the interest rate's going to be on that, and you can figure it out with the income on the property. Okay, guys, let's wrap this video up on the DSCR loan. I do want to talk about a few things to make sure that they're really clear here. One of them is interest rates. Everyone is sensitive to the rate, of course. Interest rates on this loan are determined by a few factors. One of them is your credit score, as I mentioned earlier. So the higher your credit score, the lower the interest rate. The other one is the loan to value, which translates into the down payment. The higher the down payment, the lower the interest rate. So the very same borrower with a credit score on a property, if they're putting the 15% down, is going to get a higher interest rate than if they put 20 or 30% down. And that determines, of course, the payment on that. The loan size can also determine the interest rate here. You're going to find that the rates are typically higher than what a Fannie Mae, Freddie Mac loan would be for the very same borrower that provided all of the income documentation that we would get for a regular Fannie Mae full doc kind of loan. And another thing is you can get an interest-only payment potentially on this loan, and with a larger down payment, 30% or more down, and an interest-only payment with a good credit score borrower, the payment is probably pretty close to what a Fannie Mae payment would be. And most of our borrowers here who do this loan are very focused on the payment because they also want the property to debt service itself. They want to have positive income coming off every month on the property. Interest-only payment has a slightly higher rate potentially than an amortized payment, but the overall payment is going to be lower because you're only required to make an interest-only payment on the loan, and that's the minimum payment you can do. You can make more than that even if you have the interest-only option, guys, but you're required, the minimum payment is the interest-only payment option. Down payment and reserves. I mentioned before that the down payment mostly has to come from the borrower that's buying. 10% down minimum comes from the buyer. Anything larger than that, if you put a 15% or 20% down, can be gift funds depending on the lender we send these to. I want to point out here, we sell these loans or broker these loans to different investors that do the loan, and their guidelines can vary depending on the investor that takes the loan. So what I'm saying here is kind of a global thing, but when we get in a particular situation and you want a particular rate, that lender may have different guidelines than another lender, and they may not allow you to put 10% down. They may want all of the down payment to come from your funds. How we determine your funds, we're going to get 60 days worth of liquid asset statements. That's bank statements, money market accounts, stock accounts, whatever they may be. You can use your retirement account and potentially pull the down payment from that. We're going to take a 60-day look there. If there are no large deposits coming in, which means that the regular cash flow looks kind of normal, that means that the beginning balance is about the same as the ending balance, you're probably fine there. If there are large deposits coming in from somewhere, we're going to ask where they came from. If they came from a source which is unacceptable, like someone else just gave you the money, for instance, that's not going to be acceptable for the down payment there. Reserves are important as well. We don't want to take your last dollar for the down payment when you're purchasing a property here. We typically want to have a certain reserve requirement, and normally what that is perhaps 6 months of the new payment on the property you're purchasing. If you hold other investment properties, the reserve requirement will typically be higher. There's a calculation there depending on the number of properties you have and what the payments are there. So understand, you need to have the down payment and closing costs if you're purchasing, plus additional funds in some acceptable account, your bank account, potentially a retirement account, to cover that reserve requirement as well. No maximum number of properties. That's what I love about this loan. That's what our investors love about this loan. You can continue to buy properties with the DSCR loan as long as each property supports itself. It's a very simple loan, guys. I hope you enjoyed this video. If you have any questions, certainly reach out to me. Happy to chat with you about it. Everybody's situation is different. That's why we should chat first, get to know what your goals are, and specifically put something together that works for you. Thanks. Give me a call.